Hi, I'm James Robinson. This is my continuing stock pick analysis for Gilead. This video is focused on wealth creation, Gilead's ability to create wealth for its shareholders. So the first thing we look at is shares outstanding. The company has bought back about 40% of its shares in the last 10 years, and you can see that it's a trend that seems to be continuing. That means that I own a larger portion of this company every year, and if the company's earnings go up a little bit and they buy back shares every year, I get richer and richer every year. And you can see stock buybacks, they've done a decent job of buying back stocks. The last couple of years, they've bought back less shares, but that's because they paid off a significant amount of debt instead. Shares repurchase, shares outstanding, the company's done an excellent job on that front. So looking at stock repurchase through a different lens, if you own 10% of Gilead stock at the end of 2008, you would have owned about 184.13 million shares. Today, through stock repurchases, if you'd never sold a share, your 184 million shares would mean that your ownership in the company has gone from 10% to 14.19%. So you'd have about a 41% increase, 42% increase in your ownership in the company, and you've done nothing. You just sat there and held the stock all that time. In addition, your share of the company's earnings would have gone from $263 million to $773 million over those 10 years. So we'd have significantly more earnings, and we'd be getting richer through doing nothing as a result of the company buying back shares. It seems that over time, a company's stock value will in some way reflect its shareholders' equity. You can see this company has managed to increase its shareholders' equity really almost every year with one exception since 1999. So the company does a good job on that front, and we believe it will continue to happen. This company's trading at about 4 times its shareholders' equity, which doesn't seem out of line for me. In addition, return on assets for the company, historically, it's been above in the top 10% of companies that we look at, with a few exceptions, really since about 2007. In the last couple of years, it's dropped. We think that's a short-term trend. We think we're going to reverse that and get back to where we want to be. So a company's return on assets are excellent, and that's a way that the company creates wealth for us. It's not using very much of our money to create all the earnings that it's creating, and so that's an efficient use of capital, and that's something we like as a shareholder. Return on equity is much the same, but the company, you can see, is getting better than 25% return on equity. That's fantastic. Just slightly below the top 10%, but again, this company's debt, while high, isn't ridiculously high, and some of these companies that are getting much better returns on equity are also doing it through a tremendous use of leverage. So we really are excited about this company's ability to efficiently use assets and efficiently use equity to create wealth for us as the shareholders. So we really, again, it's a reason we really like this company. So retained earnings, we look at retained earnings as, the fact that the company needs to take our money to continue to grow the business. We look at retained earnings generally as a negative issue unless the company's able to get fantastic returns on that retained earnings. The good news here is you can see that while the retained earnings were going up pretty dramatically year in and year out, they kind of leveled off and actually they've gone to virtually no retained earnings for the last few years, and that's as a result of buying back shares and paying off debt. So the company's retained earnings seem to be flatlined for the last 5 years, and earnings have gone up, in the last 2 or 3 years. So the company's retained earnings are not a problem for us. So this slide is hard to make sense of. This is return on retained earnings. So what we've done is we've said, how much of our money has the company retained for operations in the last 10 years? And then we've said, how much did the earnings grow over that same 10-year period of time? We recognize it's an oversimplification, but at least this gives us a guideline to see, okay, this company is taking a certain amount of our money, and as a result of holding that money, they're growing profits. And while there's not cause and effect, we think the correlation is relevant enough for our analysis here. You're going to look and you see that for a few years they were getting an 1,800% return on retained earnings. That was when the company was very small and some crazy things happened. Again, in 2007, they were getting a 450%. Again, that's not sustainable. But because those high numbers are in there, it's hard to read these last few years. The last 3 years, they got about a 15, a 17, and an 18% return on equity. Anything over 10% I consider great. So I'm very comfortable with that, even though it looks like they sort of flatlined down at 0. It's only because this chart is so thrown off by the scale of the earlier returns on equity. So return on equity of this company is excellent. So this chart kind of looks at the company's ability to create wealth, and we look at wealth as ways that the company can create wealth for us as shareholders. Is it paying back debt? And you can see that this company for a number of years wasn't paying off debt, but it has in the last year. So it gets negative marks in that category. It pays dividends. You can see that it started paying dividends 4 years ago, and that's starting to show up. Is the company buying back stock? Again, you can see that it bought back significant shares of stock over the last 10 years. And so we have an annual wealth created number, and we have a cumulative wealth created number. And you can see that, you know, in the last 30 years, they've created about $15 billion of wealth for the shareholders. It's great. I'm very happy with it. It's a solid company. It obviously is a little more topsy-turvy, and it's a little bumpier than we'd like. But those are the things that give us good buying opportunities. If it just went up every year at a flat rate, everybody would own it, nobody would ever sell it, and we'd never get a chance to buy it cheap. So this chart looks at the investments that we have made over time. Since we last posted, you remember that we sold Apple, then the trade war with China heated up, Apple dropped pretty dramatically, and we bought it back. Really, we bought it back about a month later, and we have now since sold that again. We owned it for about 31 days and went up about 15%. We sold it about, I guess about 215. It's about 220, 225 now. I don't mind that other guys are making money we didn't make. We did great on that investment. Martin Transportation, we owned that for 184 days and sold that, made a nice 20% profit on that. And I guess on the Apple, we made a 10% profit. And then USANA Health Sciences, which we'd owned for 53 days, we then sold that on the 11th. By the way, all of these trades, when I make them, when I buy or sell something, I no longer do a new video specifically, especially if it's a company we've already analyzed, but I always put on my Twitter, and the Twitter is @RobinsonStocks. And if you go there, you'll see that we are posting when we buy or sell something so that you'll know what's happening. Also, since our last video, we've repurchased and reestablished a position in H&R Block. You remember that we initially bought H&R Block back in April. We bought it on April 8th. We sold on the 16th. We purchased $24 a share. We sold it $28 a share, which is about a 15% profit. We've now gone back and repurchased it at $24.18. So we're actually buying it now cheaper than we bought it, whatever it was 6 months ago. So we're back into H&R Block, and then today we're going to add, today's Sunday, so on Monday morning we'll go ahead and add, we'll add Gilead Sciences, which is GILD, and we'll add that to the thing. But long story short, we're up about 20% for the year. That's fantastic. The S&P is up about 10%. So very happy to be doing that well. Some of the stocks that we own, we've got some losses in, we've got some profits in. But long story short, I think we're doing okay with our holdings. And some of these stocks, you got to remember, we've now bought and sold, we've bought stocks and sold about 10 of them for a profit. And so, some of these stocks that we've got that we have a loss on, we're going to end up selling those with a loss. Not everything we invest in is going to be a winner. We just hope that we can get, 2/3 or 3/4 of them to be winners. So that's all I got for this week. Thank you very much for your time.